the capital budgeting. The name of the topic is capital budgeting. It is there in our unit 2 under the heading capital structure. This topic is there in our syllabus. So the name of the topic would be capital budgeting and budgeting. Let us discuss what capital budgeting is. Capital budgeting basically refers to planning the deployment of available capital for the purpose of maximizing the long-term profitability of the firm. What does it mean by this? That the firm has to deploy its capital and plan its capital in such a manner so that the long-term profit of the company will be maximized. It is the firm's decision to invest its current funds most efficiently and in an optimum manner so that our long-term activities and profits will increase. This is basically the main meaning of the capital budgeting is. So if one wants to write the definition of the capital budgeting, one may write that capital budget may be defined as the firm's decision to invest its current funds most efficiently in the long-term assets in anticipation of an expected flow of benefits over a series of years. So when we read this chapter, we should have in our mind that the capital should be employed in the firm or the company in such a way that its impact in terms of profitability of the company will be over a series of years. It should not be for 1 year, 2 years, or 5 years. So long term benefits should be seen. Therefore, it involves a current outlay or series of outlay of cash resources in return of an anticipated flow of future benefits. See, benefits cannot be measured. Okay, it can be just expected, budgeted, or it can be anticipated. Similarly, the loss can also be anticipated. We cannot just for in the beginning of the year we cannot make our profit and loss account, and we cannot know how much profit the firm is going to earn for this year. We can have the data of the previous year only. So from the previous year we can know what the profit the firm has, and in the beginning of the year the firm can only anticipate that how much profit it is going to earn or it may earn in this year or in the next year or in the following or subsequent years. So that has to be kept in mind for the capital budgeting purposes. Capital budgeting is the process to identify, analyze and select investment projects. What does it mean by the word investment project? Investment projects in finance means that a firm has to decide whether to go for buying a new machinery, new planter machinery or not. That is the one of the decision that a firm has to, or a finance manager has to take for his firm. How much the benefit the firm is going to take from that new plant and machinery, because it requires a lot of investment, a huge amount of investment may be required for a big firm. So that has to be seen, and how long that investment is going to yield the benefits to the firm, that has also to be seen. Whose returns, or returns means cash flow. Okay, how much inflow is coming to the business, that is the returns, are expected to extend beyond 1 year. As I discussed, that it should not be calculated only for 1 year. beyond 1 year. It should be beyond 1 year. So firms' investment decisions would generally include expansion, acquisition, modernization, replacement of fixed assets, or long-term assets. So it basically involves the investment decisions are basically taken on these parameters. Number one is expansion. If the company has grown and now the company sees a bigger opportunities in the market, companies finding that their products are being sold across India and their demands has increased and they have orders from overseas also. In that situation, they must be planning for expansion of the business so that they can produce more and more products or more and more units of the products so that they can sell or they can reach out to the maximum customers. In that case, expansion can be done in two ways, either to acquire a new company, similar company, either to go for buying a new company or acquiring a new company. That's what they are saying, acquisition, or to expand their own business, to expand their own firms capacity. How can they expand? By buying a new plant and machinery, by setting up another unit at some other location. So these are the modes of expansion. Then acquisition, that I have already discussed. Then modernization. Modernization is also very much required because in today's scenario, every day industry is industry is required to be updated, new and advanced technology. With old technology, you cannot generate more and more profit. You cannot produce more and more units. That's why modernization is required and advanced technology is also required. Then replacement is one of the decision, whether to replace the current fixed assets, the current plant and machinery, or whether to uh, continue with the same, or whether to buy. One is replacement, another is to uh, making repairs, some repairs in the existing plant and machinery and continuing with the same. So as a finance manager, one has to take a decision which one is viable for the firm's benefit, and accordingly the calculation has to be made and accordingly the decision has to be taken. So from the above definition, we may identify the basic features of capital budgeting, namely potentially large anticipated profits. This is one. Potentially large anticipated benefits related to high degree of risk. When you are anticipating high degree of profits, then there are risks are also involved in it. Okay, and a relatively long term period, the initial outlay and anticipated return. Initial outlay will be very much, because buying a new plant and machinery may involve crores of rupees. So your initial outlay, it means initial outlay means initial investment. You are investing crores of rupees and your anticipation is very less. Then it is a very bad decision. This decision is not good from the financial management point of view. So as a finance manager, one has to see how much viable this project is. Then there is capital budgeting involves, what are the things? The search for new and more profitable investment proposals. They have to search, as a finance manager, finance department has to search the new and more profitable investment proposals. The making of an economic analysis to determine the profit potential of each investment proposal. Each investment proposal has to be seen how profitable it is and what is the potential of that investment, what is the anticipated profit of that investment, how much yield the firm is going to earn or generate from that investment. In simple, capital budgeting refers to the total process of generating, evaluating, selecting, and following upon capital expenditure alternatives. So what is capital expenditure? Capital expenditures are basically those expenditures which are incurred by the company in huge amounts to benefit of the company, to generate more and more profits for the company. That is what capital expenditure is. Capital expenditure is not incurred every year. It is incurred once in a year, or maybe after a long time, after a longer period of time. Again, some investments, if some investments are required, then this decision is taken of capital expenditure. Another thing is revenue expenditure. Revenue expenditures are those expenditures which are incurred to run the business on a day-to-day basis to generate revenue. Okay. Now, capital budgeting may be defined as the firm's formal process for the acquisition and investment of capital. Investment of capital, as I already discussed, means whether by deploying the capital, whether to buy a new plant and machinery, or for internal expansion. It involves the firm's decision to invest its current funds for addition, disposition, modification, and replacement of fixed assets. So it has got process. So how would be the flow chart? The flow chart would be, first of all, project generation. Generation. First of all, the project has to be, it should come into the mind. The project idea should come into the mind. Then project evaluation is very much needed. Then project has to be evaluated on all the parameters like profitability, like initial outlay, like sourcing of the fund, like cost of capital. All these parameters has to be evaluated for that particular project. Then there may not be one project, there may be several projects. The project department has to give the proposal to the senior authorities of the company or of the firm, and they have to select from that project, they have to select one or two, and then that project has to be executed. So this is the flow chart. What is the flow chart? The flow chart of capital budgeting process is project generation, then project evaluation, then project selection, then project execution. So what is project generation? Project generation is basically investment proposals of various types may originate at different levels within a firm. The investment proposals may fall into one of the following categories, namely, number one, proposal to add new product to the product line. Proposal to add new product to the product line. Number two, proposal to expand capacity in existing product lines. Number three is proposal to reduce the cost of the output of the existing at any level, from top management level to the level to the of workers. The proposals may originate systematically or haphazardly. So from this, what they are saying under uh, point number one, they are saying proposals to add new product to the product line. Suppose a company has many products. Okay, like let's take example of Colgate. Colgate, they are making what they are making. They are making toothbrush, toothpaste. Okay, uh, they are making this oral mouth uh, mouth freshener or mouth washing. Okay, then they may come with an idea of, let's say, Colgate soap also, because they are related. They may, I mean, this germs killing soap they may make, and that soap may come under the product line. I mean, the same under same segment, they may plan to add a new product. So this is one of the decision. Okay, another is proposal to expand capacity in existing product line. Suppose a company is getting more and more orders due to the quality of the products or due to the demand of their products, their orders are increasing. So in that case, they have to decide or take decision whether to expand the capacity. So how will they expand the capacity? If your firm's capacity is to produce only 1000 units, then you have to add another machinery. You have to buy a new machinery to expand the uh, capacity of the products, existing product lines. Then third one is proposal to reduce cost of the output. Whatever you are making, whatever you are manufacturing, your output's cost must be minimum. So to see the proposal to reduce the cost, how will you reduce the cost of the output? You have to source the material, the raw material at the minimum cost. We can understand it from this way, that if I go to the shop, or maybe a vendor, vegetable vendor, and I buy 1 kilo of 1 kg of, let's say, banana, or yes, banana, then it will cost how much? Let's say 60 rupees, 60 rupees per kg. Okay, but if I directly visit to, if I have got, from the company point of view, if I have got more orders, then I will directly visit to the farmers who are producing the banana. So from farmers, the vendors also take from the farmer. The transportation logistic costs are there, so they add that cost to the product. Then it comes to the wholesaler, then retailer. And if I directly visit to the farmers for buying the banana, then our cost will be very much lesser, because of our own transporting system, because of our own logistic systems. The cost will be seen. So in that case, in this way, we can reduce the cost of the output. Another way of reducing the cost of the output is also to reduce the wastage. To reduce the wastage, in that way also you can minimize the cost of the output. Then again, there are certain other things that are taken, decisions that are taken by the management, like from top management to lower level management. They have to see how much staffs are required for each product, for each mm, job. Are the firm overstaffing or understaffing? Are we utilizing the skills of the staffs in a proper way? That has to be seen. Now next is project evaluation. So, so under project evaluation, two steps are there. Number one is estimation of benefits and cost. So first of all, if any project comes to the management, they have to estimate the benefits, what the benefits the firm is going to have from that project, and what is the cost involved in this project. That has to be, so cost versus benefits, that has to be evaluated by the management. Then second point is selection of an appropriate criterion to judge the desirability of the project. Now our third point is project selection. Since capital budgeting decisions are of considerable significance, the final approval of the project may generally rest on the top management. However, projects are screened at multiple levels. What they are saying, after selecting the project, it is screened at multiple levels. Its impact is seen, it is analyzed from each and every angle, and then the it goes to the top level management. Then the top level management decides whether to go for this project or not. Then the last point is project execution. So after getting the approval from the top management, the funds are appropriated for capital expenditure after the final selection of investment proposals. The formal planning for the appropriate funds is called the capital budget. So the formal planning, once the top management has approved the project And so now the capital budgeting comes into role. So the project execution committee or the management must ensure that the funds are spent in accordance with appropriations made in the capital budget. So according to finance manager, the capital budgeting process is classified as under: number 1 is planning or idea generation. Number 2 is evaluation or analysis. Number 3 is selection. Number 4 is financing. Number 5 is execution or implementation. And last one is review. Now, what are the process of capital budgeting? The process of capital budgeting may be divided into 6 broad phases, namely planning, idea generation, evaluation, financing, selection, analysis, execution, and review. So this is very important. In exam, it might be asked, what are the steps or process of capital budgeting? Then the students must write that there are 6 steps are there. One is planning or idea generation. Idea generation or planning is the first step where the idea is generated for any project for capital budgeting. Another thing is evaluation of the project, or analyzing the project from each and every angle after screening it at multiple level. Then after seeing the from each and every angle, the selection is made. Out of that 3 or 4 projects, one selection or two selection is, or as per the requirement of the firm, the selection is done. And selection is done on the basis of like how much cost is involved and what the benefits the firm is going to earn over a period of time. Fourth one is financing of the project. Now comes the main role. So after selection of the project, the top management as well as the finance manager or the finance department, they have to see we have already generated the idea or planned. The plan is being evaluated. Now the selection of the plan is also done. Now from where to source the fund, how to finance the project, that has to be seen. After the selection of the project, the next step is financing. So here the main role of the finance manager comes. Generally, the amount required is known after the selection of the project. Under this phase, financing arrangements have to be made. There are 2 broad sources available, such as equity and debt. Broadly, these 2 sources are there from where or from which the finance manager has to take decision, either to go for share equity. What is equity? Equity is basically shareholders fund that is paid up share capital, share premium, and retained earning. So whether to buy or whether to invest into the new project from this amount, from equity amount, or debt. What is debt? Debt is basically long term funds or term loans taken from the financial institutions, or debentures, or working capital advances. While deciding the capital structure, the decision maker has to keep in mind some factors. What are the factors that has to be there in the mind of the decision maker? The factors should be like which influence capital structure. The capital structure is influenced by many things. Number 1 is cost of capital. What is cost of capital? Cost of capital is basically cost of acquisition of the capital. Whatever funds you are acquiring from the market or from your own source, so what is the cost involved in it? Okay. The the factors are flexibility, risk. These are the factors. What are the factors? Flexibility, risk, income, control, and tax benefit. Capital should consist of both equity and debt. It should not consist of only equity, or it should not consist of only debt. There should be a good proportion of capital and debt both, so that you are utilizing your money, company's money, firm's money, as well as you are utilizing, the firm is utilizing the loan money also, or money received from the debenture holders, or the term loans taken from outside. Now, after this, the execution or implementation has to be done. Planning of paperwork and implementation is physically different. So planning is done on paper, that is the paperwork. Okay, then analysis is also on the paper, that is the paperwork. Selection is also done on paper, but execution cannot be done on paper. Execution has to be done physically. Okay, so planning of paperwork and implementation is physically different in implementing the selected project. Implementation of an industrial project involves the stages, project, and engineering design. So these things are involving in the execution of the projects. Negotiation and contracting, that is another thing that has to be seen. Then construction, then training is also required. If your staff is not conversant with the new project, then he or she has to be trained by an expert. And plant commissioning, then the plant has to be commissioned. Commissioning मतलब plant को install करना. Installation of the plant has to be done. So these are the factors which involves in the execution or implementation of the project. What are the factors? Number one is stages like project and engineering design, negotiation and contracting. Negotiation and contracting means what? If you are willing to commission a new plant in any area, there negotiation is required. How negotiations are required? If the land is of, let's say, Adivasi, or there is a basti in that area, then you have to do the negotiation with the local people to buy the land. We can understand it in a better way. See, the Jharkhand government has not yet been able to uh, have one airport in Jamshedpur. We many a times we see in the newspaper that land has been already bought or land has been acquired by the government, but the airport has not yet been in reality in Jamshedpur. Why? Because of the land. Wherever they are going for buying land, the Adivasi people, they are uh, just protesting to sell their land to the government to give. So this is a problem. So here negotiations are required. Once negotiation is done, then contract is required. Contracting, if you are buying, if you are taking land of anybody, then you require to give job to them also, so that their once see their land is no more, the government has bought or the company has bought, then in that case, from where they will earn money, from where they will eat, they will have food after you employ them. So you have to employ them also. Rehabilitation of the people who are relocated due to the land buying. Then next point comes construction, training already discussed, and plant commissioning. Now translating an investment proposal from paperwork to concrete work is complex. Paperwork is very easy. On paper we can say that this much budget is there, this much is required, we can finance, but none of these are easy in reality, because sourcing of funds is also very complex, and commissioning the plant till from initiation or idea generation till commissioning of the plants, several complexities are involved. Time consuming and a risky task. Adequate formulation of project, use of the principle of responsibility accounting, and use of network techniques are very much helpful for implementation of a new project. So network techniques are very much helpful. Now review of the project. Once the plant is installed or commissioned, it has to be reviewed. Once the project is converted from paper work to concrete work, then there is need to review the project. Now the project has to be reviewed. Performance review should be done periodically. Under this performance review, actual performance is compared with a predetermined or projected performance. Since in the first year you have only data of the first year, so you cannot compare it with another year. So what will you do? Whatever projection you have done, whatever anticipation or uh, projected performance you have thought about, you have calculated about, and in actual, what is the performance of the project is there, that has to be compared and analyzed under the project evaluation or review. Now, project evaluation techniques. So, there are certain techniques. Number one is project evaluation techniques, capital budgeting appraisal method. So, what is the name of the method? The name of the method is capital budgeting appraisal method. In view of the significance of capital budgeting decisions, it is absolutely necessary that the method adopted for appraisal of capital investment proposal is a sound one. Any appraisal method should provide the following. What are the points? Number one is a base of distinguished a basis of distinguish a basis of distinguishing between acceptable and non-acceptable projects. So there must be distinguishing between acceptable and non-acceptable projects. Number two is ranking of the projects in order of their desirability. Desirability means if you have 1, 2, 3 projects, then you have to see which one is urgent and important, which one is not important, which can be deferred, that has to be seen. Again, there is urgent and there is important. So urgent has to be selected first, then important will come last. So in this way, the ranking of the project has to be done as per the desirability of the firm. Then after doing all these, choosing among several alternatives, then even if you have ranked the projects, now your duty is, as a finance manager, your duty is to choose among the several, what are the alternatives available with us, what else we can do. Okay, so that has to be evaluated. So from there you have to select one, choosing among several alternatives. Next point is a criterion which is applicable to any conceivable project. Next is recognizing the fact that bigger benefits are preferable to smaller ones, and excuse me, and early benefits are preferable to later ones. So so when decisions are taken regarding these things, it is seen, or it has to be seen, the bigger profits are preferable to smaller ones, and early benefits are preferable to later ones. Now, there are many methods of evaluating and ranking the capital investment proposals. In all these methods, the basic method is to compare the investment in the projects regarding the benefits derived. So, you need to make one flow chart. What is the flow chart? What should write? The heading should be project evaluation techniques, and make one arrow downward on downside. On the left side, write down traditional or non-discounted cash flow. Below that, write payback period. Below that, write down accounting role of return. On the right side, below the arrow, write down modern or discounted cash flow. So traditional one was non-discounted cash flow and modern one is discounted cash flow. Below that, NPV method. What stands for NPV? NPV stands for net present value method. NPV method. Then there is, put down one arrow, then write down IRR. What is IRR? Internal rate of return. IRR is basically internal rate of return. Then below that, write down PI method. Now, the traditional methods, that is non-discounted cash flow methods. So under this method, two methods are there. Number one is payback period method and number two is accounting rate of return method. So what are the methods under the traditional methods? Two methods are number one payback period method and number two accounting rate of return method. Second is modern methods, which is also known as discounted cash flow methods. Under this, three methods are there. Number one is the net present value method. Number two is internal rate of return. And number three is profitability index method or benefit cost ratio method. It should be kept it should be kept in mind that different firms may use different methods. So if one method is applicable to one firm, it may not be necessary that the same method is applicable to another firm also, because every organization's goal is different, every organization's nature of business is different, every organization's management mind are different, are different. Which method is appropriate to a specific project of the firm depends upon the relevant circumstances of the proposed project under evaluation. So it depends upon the relevant circumstances of the proposed project under evaluation. Next thing is investment evaluation criteria. So this is also called traditional techniques or discounted cash flow techniques. So how to decide, how to evaluate? The traditional techniques are further subdivided into two, such as payback period. Traditional techniques are further divided into two parts. Number one is payback period and number two is accounting rate of return or average rate of return, or you can say ARR. ARR stands for average rate of return. So what is payback period? Payback period is one of the most popular and widely recognized technique of evaluating investment proposals. What is payback period? It is one of the most popular and widely recognized techniques of evaluating investment proposals. Payback period may be defined as that period required to recover the original cash outflow invested in a project. It simply means that whatever outlay or investment outlay is there, okay, and how many years will it take to recover that initial outlay. That is what internal rate of that is what payback period is. In other words, it is the minimum required number of years to recover the original cash outlay invested in a project. आपने इनिशियली कितना पैसा इन्वेस्ट किया था प्रोजेक्ट में और वो पैसा कब तक आएगा, कितना पीरियड के बाद आएगा, उसको जो निकालते हैं दैट इज कॉल्ड पे बैक पीरियड मेथड. द कैश फ्लो आफ्टर टैक्सेज इज यूज्ड टू कंप्यूट पे बैक पीरियड. क्या होता है टैक्स फ्लो आफ्टर टैक्स, मतलब पैट. पैट स्टैंड्स फॉर प्रॉफिट आफ्टर टैक्स. Payback period can be calculated in two ways. How can it be calculated? Number one, using formula. Number two, using cumulative cash flow method. So these two methods are there, cumulative cash flow method and using formula. The first method can be applied when the cash flows stream of each year is equal. When your when cash flow is equal in each year or annuity in all the years of project's life, that is uniform cash flows for all the years. It does not change according to the change in years, so it is fixed. So uniform cash flows for all the years. In this situation, the following formula is used to calculate payback period. So what is the formula? The formula is payback period equals to original investment divided by constant annual cash flow after tax, or initial investment or cash outlay. In short, you can write the payback period formula as payback period equals to initial investment within bracket cash outlay divided by annual cash flow. So initial investment divided by annual cash flow and you will get payback period. The second method is applied when cash flows after taxes are unequal or not uniform over the project's life period. सेकेंड मेथड कब यूज किया जाता है? जब कैश फ्लो आफ्टर टैक्स, मतलब पैट जो है प्रॉफिट आफ्टर टैक्स, वो यूनिफॉर्म है ओवर द प्रोजेक्ट्स लाइफ. In this situation, payback period is calculated through the process of cumulative cash flows. Cumulative process goes up to the period where cumulative cash flows equals to the actual cash outflows. Put it simple, PBP equals to year before all recovery plus within bracket unrecovered amount of investment, comma, cash flows during the year. So this is the PBP. PBP stands for payback period. P stands for pay, B for back, P for period. So PBP equals to year before full recovery plus unrecorded amount of investment divided by cash flows during the year. Now accept or reject, right, rule. So how to accept or reject a project? So that rule is being given. Accept reject rule. Acceptance or rejection of the project is based on the comparison of calculated PVP. So acceptance or rejection of the project is done on the comparisons of calculated payback period with the minimum or standard back period. For example, put it simple, back period. So there are certain situations or circumstances under which you should accept, and there are certain situations or circumstances under which you should reject. So accept, in this case accept. How? First of all, calculated PBP. What is your payback period? If it is lesser than the standard payback period, then you should accept. So standard payback period से अगर आपका कम आ रहा है पेबैक पीरियड, तो उसको आप एक्सेप्ट कीजिए. रिजेक्ट, payback period is more than the standard PVP. If payback period is more than the standard payback period, then it should be accepted. Yes, rejected. In the first case, if payback period is lesser than the standard payback period, then it should be accepted. And the second case, when payback period is more than the standard payback period, then it should be rejected. Now considered, then when should, in one case it was accepted, in another case it was rejected. So considered payback period is equals to standard PVP. In this case, what will happen? Now advantages of payback period. The methods of payback period are, it is very simple and easy to understand. It is very, the beauty or the advantage of the payback period are, the merits of the payback period are, it is very simple and very easy to understand. Cost involvement in calculating payback period is very less. Cost involvement in calculating payback period is very less as compared to sophisticated methods. Now there are certain, see, it has, payback period has got many advantages and currently this is followed in use. So what are the limitations of payback period? Payback period method suffers from certain limitations such as it ignores cash flows after payback period. After the payback period, it ignores the cash flow statement. Payback period method suffers from certain, it ignores the cash flow after payback period. Number two is, it is not an appropriate method of measuring the profitability of an investment, as it does not consider all cash inflow yields by the investment. So what are the limitations? 1 minute. Yes. So what are the limitations? The limitations are, it ignores cash flows after payback period. Number two is, it is not an appropriate method of measuring the profitability of the investment, as it does not consider all cash inflows yields by the investment. Number three is, it does not take into consideration time value of money. What is time value of money? Time value of money is that if a person is getting 100 rupees today, if a business has to pay, let's say, 1 crore today for buying any new machinery, or the firm has to pay 1 crore after 6 months, then which one is viable? I mean, pay, how to pay? This decision involves time value of money. So it does not take into consideration the time value of money. Time value of money is also very important and it is there in our syllabus. It is very important. Okay. Next is, there is no reasonable basis of setting a minimum payback period. So under this, the limitations or disadvantages are like, there is no any rational basis for setting a minimum payback period. Next is, it is not consistent with the objective of maximizing shareholders' wealth. It is not consistent. The main objective of basically the main objective of financial management is wealth maximization, another is profit maximization. So it does not consist with the objective of maximizing shareholders' wealth. Share value does not depend on payback period of investments. So for calculating payback period, we need cash flow after tax. So you need to know how the cash flow is prepared and how we derive the cash flow after tax. After tax is PAT, profit after tax. So we are having one table. Under this table, the things are written. Calculation of cash flow after tax. How it is calculated? It is calculated. You need to write down. First of all, particulars has to be written down on the left side, and on the right side, rupees or amount within bracket rupees has to be written down. First of all, write down sales revenue. Sales revenue will be there in the question. So sales revenue you have to write. Then from sales revenue, deduct variable cost. Variable cost is directly proportional to the number of units produced. More number of units are produced, more amount of variable cost will be spent, will be incurred. So sales minus variable cost, what we get? We get contribution. From that contribution, it is called contribution. From that contribution amount, we need to deduct fixed cost. So what is fixed cost? Fixed cost is basically that cost which is fixed irrespective of the number of units produced. So from contribution, you need to deduct fixed cost. So after that, what you get? You get earning before depreciation and taxes. That is called EBDT. E stands for earning, B for before, B stands for before, D stands for depreciation, and T stands for taxes. So sales minus variable cost, that is contribution, contribution minus fixed cost, that is EBDT. From the EBDT or earning before depreciation and taxes, just deduct depreciation. Depreciation, what is depreciation? Depreciation is basically wear and tear cost, and it is charged every year, and it is shown as an expenses under the profit and loss account. So this expenses, but it is notional cost. It is not the cash that the business is spending in actual. It is not the outflow of the cash from the business in actual, but it is a notional cost. But still, your profit is reduced from by that amount. Your profit is, the firm's profit is reduced by that amount. So deduct depreciation, and after deducting depreciation from EBTT, whatever you get, the remaining amount is called earning before taxes, EBT. So from that EBT, you need to deduct what? Taxes. There would be, in the question, there would be taxes at the rate of this percentage, or this much amount of tax is there, that has to be deducted. So whatever is there, you have to deduct EBT, taxes, and whatever is remaining, that will be earning after tax. Earning after tax. Now, to get the cash flow after tax, you need to add back depreciation amount also. In the EAT or earnings after tax, you need to add back the amount of depreciation, because as I already said, the amount of depreciation is not an outflow of cash in actual. Actual cash is not flowing from the business, not going out from the business. It is just a notional cost. So depreciation has to be added back, and then whatever you get, that amount is cash flow after tax, or you can say earnings after taxes but before depreciation, EATBD or CFAT, cash flow after tax. So in this way you will get calculation of cash flow after taxes. So in today's session, what else we have covered? We have started a new topic. That topic is capital budgeting. It is there in the syllabus. It is in Unit 2 of MBA course. It is under Unit 2. Capital budgeting. We have discussed the meaning and definitions. Then what are the things involved in under the capital budgeting that we discussed? We prepared one flow chart of capital budgeting process. Then what are the steps or process of capital budgeting that we have discussed? Then we have covered the project evaluation techniques. This we have covered. Then what are the methods of project evaluation? We have discussed about buyback period method. We have discussed about accounting rate of return method. Then we have also discussed about modern methods, traditional methods. We have discussed about the net present value method. We have discussed about internal rate of return method. We have also discussed about profitability index or benefit cost ratio method. We also understood or we have discussed about when to reject a project or when to accept the project. I mean, what to check when to reject or when to accept the project. Then we have also discussed the limitations of payback period. And finally, we have discussed how to arrive at the calculation of cash flow after taxes. So this up to this we have covered. In the next class, we will be covering some other topic. Thank you.